While we're getting ready to gobble, gobble, gobble up a bunch of food this Thanksgiving, try out your mother-in-law's great tasting cranberry sauce this Thanksgiving, let's be sure to include our appreciation for how many great income ETFs are out there. Now, ranking income ETFs is never easy, but I will be sure to trigger as many people as possible by leaving their favorite income ETFs either off the list or not ranked high enough. So make sure you let me know which ones that you would personally rank higher or lower in the comments below. So let's get straight into it, guys. What is the criteria, the methodology that I use to help me determine how to rank these income ETFs? So I put extra emphasis on the performance since October 13th. That was the last time that my last power ranking video came out. Extra emphasis will be placed on how the fund has performed since October 13th. And of course, one huge thing that I look at is maintaining that NAV. Now, a lot of income ETF YouTubers, they will just pretend that the dreaded words of NAV erosion do not exist, but we don't live in such fantasy lands on this channel. Here we actually look at the truth. What is the fund doing? Are they actually making money? Are they maintaining that NAV? Because in retirement, you don't want to be stuck with an ETF that isn't actually making money and is just giving back your own investment in the form of a dividend. That's what they're calling it. That sounds awfully similar to a Ponzi scheme. So again, that's why I put a lot of emphasis on NAV. Now, if we're getting price appreciation, that's also just a nice cherry on top, or extra gravy, if you will. Price appreciation is great, but when we have income ETFs giving us super juicy dividends, it's not the biggest thing in the world either, but it's nice to have. Of course, what we're really looking at is the big old dividends, dibba. Now, there's a difference between dividends, which is, again, actual profits that the income ETF is making through its various strategies, whether that's options trading. We want to get paid out the actual profits. We don't want our principal just returned to us. Again, that is a Ponzi scheme. So we care a lot about the dividends and, of course, the history. How long has the fund been out? What's its history of paying out dividends? And how has it performed since the last time we made this video? So all those are very important factors to consider. So these are the stocks that just missed the cut. They were just on the fence of cracking on our top income ETFs rankings. I don't want this video to be super long, so I'm gonna go through this pretty quick. I've already made pretty detailed videos on basically all of these income ETFs, so check those out. But the first one to miss it was SPYT. This is by a provider called Tap Alpha. It's a very interesting name. We come up with some really interesting names in this investing space. We've already had Seeking Alpha. Now we have Tap It Alpha. Hey, if they want to tap, they can tap it all they want. So this is another primary 0 days till expiration options trading strategy. So it has a long call position on the S&P 500 with a short position on certain call options. It gives about a 13% yield, but it's only been around since August of 2024. So it's really brand spanking or brand tapping new, so it needs more time to be ranked higher on this list. Then we have SPYT by Simplify. I've made several videos about them. I've even had their fund managers on this channel before. So they have unfortunately had to deal with these lower interest rates, that the Federal Reserve is lowering interest rates. So that means that the monthly dividends that they pay out, it's going to keep going down, but I still think it's given out a great yield. It's a great fund overall. And then we have a newcomer on this list, QDPL. This is by Pacer. This is the US Large Cap Dividend Multiplier 400. Now, I really like the name of that. Please do more multiplying of my dividends. That is a great name. So it's been around since July of 2021. The NAV has went up around 15% in that time span. However, the yield is quite, and I'm putting this in air quotes, low at only 5.3%. And they only pay dividends every quarter. So I know that's going to turn off a lot of income ETF investors. Of course, people that learn to budget correctly, it doesn't really matter or make a difference when they pay out. So these are the ETFs that just missed it. Number 11, BITO, ProShares Bitcoin ETF. So BITO, or BITO was his name, is the first of many Bitcoin-fueled gains on this list. Now, why is Bitcoin and crypto doing so well in recent weeks? While many are optimistic, the newly elected Donald Trump and his posse, that they will be more pro-crypto than other administrations have been. They might have more favorable legislation. They might have a more hands-off approach. This could allow more and more Bitcoin-fueled ETFs, and just a lot more people using it overall. So Bitcoin could be ready to crack $100,000 for the first time ever here real soon, and ETFs like this will really benefit from it. So BITO might not be a true income ETF. It doesn't directly own Bitcoin. Instead, it owns a lot of Bitcoin futures contracts. Now, this is a very high risk, high reward type of fund, but it is up over 35% since the last video in October, and it has paid some mouth-watering dividends. We're talking about ballpark of 45 to 60% yield. Now, this fund has only been around since October of 2021 and has had quite a bit of NAV erosion, but right now it's super hot. Number 10, SPYT, Defiance. All right, I know some of you are a little bit disgusted that I don't have a nice round number for these income ETF power rankings. We don't just have the top 10 on this channel, we have the top 11. But number 10 is SPYT. So SPYT holds shares of the S&P 500 ETF and then does a daily credit call spread, hoping to target around 20% of annual income. Now, a lot of Defiance ETFs have disappointed me in the past, but this one has held pretty steady. It's up a whole 1.15% since October. It's only been around since March, so not too long, and it hasn't had much NAV erosion, and it has consistently paid around a 33-cent dividend since inception. Just like I said last time, a real market downturn will be the first true test for this fund to see if it belongs in a portfolio for the long run. Number 9, FEPI, AIPI, REX shares. Wow, how the mighty have fallen. If you guys remember, FEPI was once ranked among the top income ETFs on this list, but it has since fallen on some flat times. While other income ETFs are going up with the market, both FEPI and AIPI have not been going up. While other income ETFs own or track hundreds of stocks, neither of these funds own that many holdings. They're less than 24. So that means if a stock is not doing as well, it's going to drag down the overall holdings much more than, say, you owned 100 or 500 different stocks. Now, I will give FEPI, AIPI some credit. Their dividends every single month have been very consistent. AIPI keeps paying around $1.50. While FEPI is consistently giving out $1.09, giving around a 35 to 25% yield across these two funds. That is very impressive, and that is what's really important. If I was a FEPI or AIPI shareholder, I'd still be very happy with these two income ETFs, but to be on these power rankings, you always have to bring your A game. That's why I had to dock them a little bit since they were down 27 basis points and 99 basis points since the last video. Number 8, IWMI NEOS. This is a new income ETF. Thank you to my Discord member A-Dubs for the recommendation. Remember, if you ever have any income ETF recommendations, put them in the comments below, or if you want to see yours ranked higher, let me know in the comments. I do take that into consideration when ranking these income ETFs. Now, NEOS just continues to put out another great product with IWMI. This is the Russell 2000 Index Covered Call ETF. Now, they've been out since June of this year, and they have returned about 6% in capital appreciation, but they're hovering around a 14% yield if we annualize that. Now, the Russell 2000, it focuses on 2,000 of the smaller cap publicly traded companies, and that offers some volatility and some juicy premiums. The juice is real with this one. Now, it has an expense ratio of 68 basis points, so not super cheap. Remember, 68 basis points is $68 for every $10,000 invested. Their last dividend was 63 cents, right in line with how recent months have been. Let's see if IWMI can keep up the hot streak. They were up a whole 3.3% since the last time of this video. That is some fantastic performance to see. Number 7, SPYI, QQQI, NEOS. Let's keep up the NEO circle love. Circle love is what I meant to say. The dynamic duo of SPYI and QQQI joined by IWMI. We might have a total team control trifecta in the great income ETFs here by NEOs. Great job by NEOs. The two on this slide match the indexes that are obviously named after them. These ETFs offer consistent monthly income with its data-driven call option strategies. You got fund professionals doing all the work for us. They charge, again, a 68 basis points expense ratio. But remember, guys, we're just sitting back, relaxing. Other people are doing a lot of the work. I just did some call options on NVIDIA this morning. Oh my gosh, the amount of stress it was causing me to pick the strike prices, to do all the strategy, the trading. Honestly, sometimes it's worth it just to outsource this part of it, just have it on autopilot, have other professionals do it for you, and just return some of that profit to you. Now, both have had capital appreciation, NAV erosion since their inception. SPYI is up 7.4% all time. QQI is up 4.3%. SPYI is consistently giving juicy dividends we can one day use to pay for all of our living expenses. SPYI's dividend of 52 cents was a penny more than last month, and QQI following the trend with a 61 cents a share. They also gave a penny raise. So we're getting around a 12 to 14% dividend yield annualized. That's over a 12-month stretch. They were up 1.12% and 1.02% since the last time this video was made. Number 6, iSPY, IQQ. Now these two funds by ProShares were up 2% and 2.8% since the last time we made this video. Again, they do a daily call option strategy, and you can expect anywhere from 10 to 14% dividend yield with these two. So with ProShares high income, we get the potential of selling call options each day, and that can produce a high level of income, and it's efficient income generation, right? We're seeking income, we're targeting the S&P 500 returns for the long term. S&P 500 over the long term does very well. Just look at any chart. And we're getting some of those returns as well with our covered calls. It might stunt it a little bit. We're sacrificing that for those juicy dividends, those juicy premiums. Now, iSPY's dividend was 3 cents higher than the previous month, so they didn't do a penny raise. They did a 3-penny raise. Then we have IQQQ, which gave us a dividend of 10 cents. No, not a dividend raise of 10 cents, a dividend of a whole 10 cents. IQQQ has been very inconsistent with their dividend payments. It was way too big in September at 82 cents, slightly smaller than usual at 32 cents the month after that, and then next to non-existent in November. It almost feels like the dude who was in charge of giving out dividends accidentally gave out too much in September and then had to compensate by giving out smaller ones in the following months. Whoops! Number 5, BALI, BlackRock. Popular in the comments is the income ETF, BALI. People always talking about BALI. BALI is on fire. BALI is helping investors in retirement. BALI is ballin' by paying the bills. Now, BALI has their own stock selection process based on data, rich data. And of course, they're gonna get us monthly income by selling call options. And there's also some chance at some potential upside and some lower volatility while they do it. It's just the best of both worlds with BALI. Now, BALI is up 25% all time while claiming a 7% dividend yield. That is quite impressive. BALI's strong performance has me ranking it even higher on this month's list. Number 4, XDTE, QDTE, Roundhill. So these have been up 1.31% and 75 basis points since the last time this video was made. This is the weekly dividend payer. It takes number 4 on this list. Now, I've already made several videos pointing out why getting paid weekly versus monthly makes next to no difference from a cow pounding perspective. The high yield dividend warriors are convinced that they have found the magic beans to be able to retire early. Now, these funds have only existed during a bull market. They have never been tested during a bad market, a bear market. And no, the market going down a few percentage points, then rapidly climbing back up in August doesn't count as a bear market. Many in our community, they have this thing called HYDS, or high yield derangement syndrome. It is a serious epidemic originating in the brain, but most of the serious side effects will be felt in the bank account once a bear market comes clapping. Yes, the clappening will happen. Are you prepared for the clappening? Regardless, both funds were up about 1% in the last month. Their NAV has been relatively stable. NAV erosion has only really been slightly apparent in QDTE so far. And if they can keep up this ridiculous 25% plus dividend, investors will be quite pleased. Number 3, JEPY, JEPQ, JP Morgan Chase. These two ETFs were up 2.05% and 3.85% since October. So they've had some not only mouth-watering capital appreciation, but they've also paid some juicy dividends as well. This is the dynamic duo of the JP Morgan Chase funds. JEPY has been out for 4.5 years, which is pretty crazy. They've actually seen some down days, but the fund is still up 21%. Now that is very impressive. If I was looking to live off my dividends, I would need to know that my principal is not only protected, but it keeps going up, right? Inflation. We keep printing more and more money. I need to know my principal is going to be going up as well. JEPY is giving around a 7.7% yield. Their last dividend of 37.5 cents was slightly less than the previous month. JEPQ has been up about 15% in the 2 years that it's been out, and it gives around a 9.3% yield. Its latest dividend was the lowest since August, down 6 cents from the previous month at just 49 cents. Overall, I gave them a bump because of their long history, great capital appreciation in the recent months, and still giving out that steady dividend. Number 2, YMAX, MSTY, Yield Max. Oh boy, this is gonna be fun. All right, this is the reason why many of you are here, to talk more about MSTY. I've already made a couple videos on MSTY in the recent weeks. Let me just remind you guys that MicroStrategy, the company that MSTY is doing its options trading on, is a company that does not consistently make money and is up unholy amounts. And many truly still thinking that we are not in a bubble. Truly baffling. It hurts my brain sometimes. Like, many think there's a tariff on stupidity. Again, MicroStrategy, the underlying position of MSTY, owns a bunch of Bitcoin. And Bitcoin has done very hot lately, like we talked about. But crypto, time and time again, just shows it can go down just as quick as it shoots up. But the HYDS, but the high yield derangement syndrome is real with this one. Get tested for HIDS, guys. It is a serious epidemic. High yield dividend warriors think they have found the cheat code. Yeah, the only cheat code that you guys have found is finding a way to severely underperform MSTR by holding MSTY. But it's not all bad. I rank them number 2 for a reason. These power rankings are a lot of what have you done for me lately. It's not what have you always done for me. And lately, MSTY has been a cash flow machine with its cult-like followers truly thinking they are making free money. MicroStrategy is up 458% so far this year. Again, I want to emphasize that they don't actually make any profit so far once you take into account all their expenses. Now, the income has been great. They've been paying out so much in dividends. But truly, I think it is a ticking time bomb. I would not feel comfortable with either of these in my portfolio long term, but I cannot argue the short term results have not been nice. YMAX was up 3.63%. MSTY was up a mind-boggling nearly 14% since the last video. Enjoy this number 2 ranking. I don't think we're ever going to see them rank this high again. Before we get to number 1, I want to congratulate my newest Patreon member, FEPI. They now get access to my full $220,000 plus portfolio and all my weekly trades on Patreon. These videos do take a lot of time for me to put together. These people help make this channel possible. If you're not able to join the Patreon, please be sure to either leave a like or hit the comments. Number 1, GPIX, GPIQ, Goldman Sachs. These were up 2.72% and 2.67% respectively. Guys, this is starting to become too easy. Goldman Sachs income ETFs just continue to crush the competition. This is a dream. This is a sleep well at night ETF that offers juicy dividends and gives us amazing capital appreciation. GPIX is up 29% all time, is about 13 months of history now, and GPIQ is up 26%. They are consistently giving that 7 to 10% yield. The NASDAQ 100 tracking one just gave one of its largest dividends of all time at 42 cents, and it's the same story with GPIQ. So not only do they have increasing dividends, increasing capital appreciation, they have consistency. No NAV erosion, no bubble in the options trading. It has no cult-like following just yet. Yeah, it's no wonder why Goldman Sachs continues to top this list. Let me know what you think of my power rankings in the comments below. I read all the comments. I take them into consideration when making these rankings. Come join other dividend investors who are retiring early in the Discord link below. Make sure you guys leave a like for a small-time creator. I've beat the stock market the last 3+ years. Check out the Patreon link for all my weekly trades. My videos are found in podcast form under the Clapped Cash podcast name.
So somewhere at the end of 2026, I'm taking off my uniform. I'm going to start paying my bills.